Hey everybody, Smart Silver Stacker here. Hope you're doing well. I hope you're doing better than the U.S. regional banking system because we're witnessing today potentially the beginning of the next phase of the banking crisis. We've got New York Community Bancorp, Inc., ticker symbol NYCB today, coming under tremendous pressure. Share price dropping more than 36%. And I've got the one-year chart pulled up here. You can kind of see the similarities in this sell-off between what happened today and what was happening last March. Of course, the sell-off today even a bit more steep for this bank, but we're going to talk about this, what's going on at this regional bank, why this is a sign of broader problems that really have persisted since March of last year. I mean, we're in the middle of a banking crisis that is bigger than what occurred in 2008. And that's just if you look at the deposits of all the banks that have failed thus far and you compare that to the great financial crisis. So, actually, before we get started, I have a quick question for everybody. We have got on the screen here this little voice visualizer in the corner. Do me a quick favor. If you like that visualizer, put a 1 in the chat. If you find it distracting or annoying or whatever, put a 2. It's a new feature. I thought maybe it would be helpful to kind of follow along. I don't know. Let me know if you like it. Okay, now let's take a look at the broader regional banking sector here. You can see this regional banking ETF KRE down 3.4%. So what's going on with NYCB kind of dragging down the broad sector here? And look, I'm not trying to be FOMO with this one. I am just trying to remind everybody what happened last March. You know, if you've been thinking about doing some stacking, getting some gold and silver, you might want to go ahead and pull the trigger on that. It's not financial advice. You know, I'm not telling you what to do, but last March when the bank started to tank, the premiums on gold and silver soared, the lead time soared. So you know, you might want to pull the trigger. I'm not trying to FOMO anybody into buying this. That's just what happened. And I know that if we do see the banks come under significant pressure here, there's going to be a lot of people who gripe about the premiums soaring. So now's your chance. If you want to get some before premiums soar, you can get silver rounds for $1.25 over spot over at SD Bullion. Anyway, let's talk about what's going on with New York Community Bancorp, because I think when we analyze what's occurring with this bank, it will be somewhat telling. This is so funny. This is from Barron's. New York Community Bancorp shocked markets Wednesday morning. Are you shocked by the fact that another regional bank is failing? I mean, I don't know. I'm not. But that does seem to be the narrative here, that markets are shocked by this. And certainly 36% drop is a big deal. The Hicksville, New York-based bank posted a net loss of $260 million for the fourth quarter. That's compared with a gain of $164 million for the same period a year ago. So think about that. You go from quarter 4, 2022, making $164 million in net gains, now going to a net loss of $260 million. Huge miss, huge losses here at this bank. Analysts had expected earnings per share of 26 cents. So clearly the analysts got this one dead wrong. And, you know, what kind of confidence does that instill in you, in the analysts, in the mainstream who are telling you that everything is fine? They thought there were going to be earnings. Nope, $260 million loss. Now, notably, this bank is actually the bank that acquired Signature Bank during the bank crisis of last year. And actually, before we continue with this article and touch on some of these points, I want to go to this one from March 20th of 2023. It says this bank is buying Signature Bank assets. Its stock is soaring. Who are they talking about? Well, they're talking about New York Community Bancorp. So they bought up a bunch of these Signature Bank assets when Signature Bank was coming under pressure. Their stock was soaring at the time, but, you know, as you can see, this didn't really work out so well for them. NYCB benefits from sweetheart deal as FDIC priced the assets to move quickly. That's from analyst David Chiavarini last March. New York Community Bancorp stock jumped 41% to $9.23 on Monday morning. Much of that is a retracement of the slide from $9 to $5.81 that the bank suffered this month in response to fears for small banks. But again, if you look at the chart today, they just gave up all of those gains, or almost all of them. I mean, we're very close to the lows of 2023 in this bank. But back to this article, Piper Sandler analyst Mark Fitzgibbon wrote that the FDIC would probably not let NYCB do this transaction unless they were very comfortable with their balance sheet. Well, how's that balance sheet working out now? Not so good. The bank said net charge-offs totaled 185. This is back to the article from today. Totaled $185 million for the fourth quarter. That's compared with $24 million in charge-offs for Q3. It attributed the jump to two loans, a co-op loan that the bank expected to be sold during the first quarter of 2024. So you can read that as being sold at a loss, and an office loan that went non-accrual during the third quarter. So commercial real estate loans now having a big impact on these losses. And this is a trend that you can expect to continue until the Fed gets into these markets and drives interest rates lower, because what's going on in commercial real estate, there's no buyers. These properties are losing a tremendous amount of value. They're not worth what they say on paper, because with interest rates the way they are, there's not as many buyers. You need rates near zero to drive up the valuations to what they were when rates were zero. Surprise, surprise. Total loans 30 to 89 days past due totaled $250 million as of December 31st. That's up from $169 million at the end of Q3, according to the company's earnings report. So again, these loans that are delinquent, $250 million worth of them, how many of those loans do you think are going to get paid? Well, they're not, unless the Fed, again, gets in, drives interest rates lower, bails out these banks, bails out the commercial real estate sector. That's why the Fed is going to have to print a huge amount of money in 2024. But until that happens, these past due loans are going to continue to rise. The company says it is the second largest multifamily portfolio lender in the country and the leading multifamily portfolio lender in the New York City market area, specializes in rent-regulated, non-luxury apartment buildings. So just think about that. Think about the sector that this bank is operating in, rent-regulated, non-luxury apartment buildings. So it kind of gives you a clue as to the fact that you can't fight inflation. You can't magically control the economy by these kind of decisions by fiat, because if you've got rent-regulated apartments in a rising inflationary environment, well, that means that the landlords, their rents cannot be, or their income can't scale with inflation, whereas their expenses do increase. And, if you're going to try to control the rent and put a cap on it while inflation runs out of control, you're going to see the lenders come under a lot of pressure here. At least that's my interpretation of this. So, you can try to hide inflation by doing things like setting price caps and controlling prices, but there's these second and third order effects that you get from that as the inflation rate continues to rise. The bank said that total commercial loans represent 46% of its loans, and then multifamily loans are 44%. So, again, it's commercial real estate. We're facing a huge crisis here. You can expect more of these regional banks that have huge exposure to the commercial real estate sector to come under pressure, to continue to fail. This crisis that began in March of 2023 is not over, not by a long shot. And if you want another indicator of that, all you got to do is look at the Bank Term Funding Program chart. This is the emergency lending facility that the bank created to help bail out these regional banks back in March of 2023. You can see it's been hitting record highs consistently. Ever since the end of November, it's been ticking up pretty quickly. And supposedly in March, the Fed is going to sunset this thing, and they're not going to issue loans through this any longer. They say the discount window will continue to be available, but what's the problem with that? Well, the difference between the BTFP and the discount window, which is like a emergency source of overnight liquidity for the banks, is that when you put up collateral at the discount window, it gets marked to market. But when you put up collateral for a loan in the BTFP, such as U.S. Treasuries, they don't mark them at what their market value is. They give you a loan based on the par value. And you have all these regional banks sitting on piles of U.S. Treasuries where they have these large unrealized losses because U.S. Treasury rates remain very elevated, 4 or 5%, way above where these banks were buying them when rates were so low. And as interest rates rise, lower yielding treasuries, they lose value. So, basically what you've got is a situation where I'm just going to use, round numbers here, but you got a treasury worth $100 or rather worth $70, but it says it's worth $100 on its face, and the banks can go and get a $100 loan using these as collateral with the BTFP. And so, this is just a sign that this problem of unrealized losses on treasuries, and this was actually the thing that kicked off the failure of Silicon Valley Bank, this is still a major problem. In fact, it's a lot worse than it was in March. So look, expect more banks to fail. Expect, massive intervention once this cascade really kicks off. Now, it's interesting. We got a Fed meeting here in just a couple hours. What is the Fed expected to do? Well, they're expected to hold rates steady. I think that's probably what we're going to see. I don't anticipate any rate cuts. Could this regional banking crisis, which may be kicking off this morning, affect the Fed's decision? Well, yeah, it could impact, certainly the talking points, at least, and the answers to questions in the Q&A following the talk. So, maybe we'll see Powell throw the markets a bit of a bone here. I'm not sure. I don't think there's going to be any rate cuts, but they might have some dovish language to try to stave off what could be a major crisis. This is the narrative that we keep getting fed here. This Fed's preferred inflation gauge falls more than expected in December. So, what they're trying to do here by telling you that inflation is coming down, they're trying to give themselves cover to cut rates, despite the fact that inflation is anything but down. They know that the public, I think, understands to some extent, at least, that the Fed is responsible for the inflation problem. So they know they're going to have to cut again. You got regional banks starting to fail. The cracks starting to show here. Fed knows they're going to have to cut, but they need to convince everybody that inflation is down before they do that. Now, the core PCE, 2.9%, that's not inflation coming down. That's just inflation moving up at a slightly slower pace, that peaked at 5.5% or 5.5% in 2022, September here. All of this inflation is cumulative. That's so important to keep in mind. Inflation is still up. Anybody who goes shopping, anybody who buys anything, anybody who buys food, anybody who, buys gas, anybody who pays insurance, all of this stuff, everything is more expensive now, way more expensive. It's going to get a lot more expensive moving forward, but they're going to tell you that inflation is falling more than expected. And for the average person, they see that headline and they think, oh, that's a good thing. They're trying to get everybody conditioned and ready for more Fed printing here, despite the fact that inflation is still very high. Inflation is going to explode. That's something we got to understand. Now, I want to change gears here and just talk briefly about what's going on in the Middle East, because I think we're on the verge of a major escalation there as well. We've got Biden now telling us that he has decided himself, unilaterally, on a response to killing the 3 U.S. troops that were killed in a drone attack on a U.S. base on the Syria-Jordan border. Now, to me, I don't know about you, it seems like Congress maybe should be deciding this, or someone other than, the dementia patient currently in the White House, but that's not what's happening here. He has decided. Now, I'm sure he was presented options by the Pentagon, and, he picked some course of action. But one thing that I will say is that some people might think that the fact that a response wasn't immediate is a sign that maybe cooler heads are prevailing here. They're being a little more circumspect about how they do these strikes. Yeah, that could be the case, or it could be that they need time to stage a lot of weaponry and they've needed time to build up forces because the reprisals are going to be huge. That's the other side of that coin. We're going to have to wait and see what time tells. Interestingly, some of these Iran-backed militias in Iraq now are telling us that they're suspending military operations against U.S. forces in the region. Now, I'll believe that when I see it. But it does show, I think, that these militias are concerned about the scale of the strikes that they're about to experience. And, I think that we're going to see a major escalation here is ultimately going to be the result of this. You're seeing these militias evacuating temporarily their bases. They know that, hell is headed their way in the form of massive reprisals. And Iran is telling us that they will respond to any U.S. strikes. Biden has told us now that he has essentially linked the attack to Tehran, telling us that Tehran supplied these weapons. I mean, there's probably some truth to that, but the fact that Iran is threatening reprisals here should be of major concern. I mean, if we go into a war with Iran, are they going to strike back? Yeah, you'll probably see more attacks on U.S. troops in the region. I was watching Greg Manarino's video this morning. I don't know if anybody out there likes Greg, but I enjoy his work. I watch his videos from time to time, and he was calling for a major cyber attack following U.S. strikes on Iran. He tells us that his forecast is for Iranian cyber attacks on the U.S. financial sector. And I mean, certainly, I would tend to agree that that is a major risk here to the extent that Iran and the global south have been working on asymmetric warfare capabilities. The U.S. digital financial system is a very vulnerable target, I think. It might be our Achilles heel. And when you look at the fact that you have the banking system in the U.S. doing a pretty good job of imploding itself already without interference, I would not be surprised if our opponents on the world stage are looking at this as a potential weakness to exploit. So what does it mean? I mean, it means get prepared for anything. I did a video yesterday on stacking for SHTF scenarios, and one of the things I mentioned is having a cash emergency fund. Yeah, you might want to have that. You might want to have some assets outside of the banking system. Again, not financial advice, but that's what I'm doing. I mean, cash, precious metals, physical assets without counterparty risk, that is the way to get ready for this. Also, don't neglect your basics, food, water, essentials like that. You're going to need that if services are disrupted. We already know that U.S. critical infrastructure is vulnerable and has come under attack, probably already has malware embedded in it to some extent, and dropping direct kinetic military strikes on Iran could certainly be the event that pushes that over the line, and triggers a reprisal. I mean, maybe you should listen to the Iranians when they tell us they'll have reprisals against any strikes on them. I mean, I don't think they're bluffing. What will that mean? Maybe the shuttering of the Straits of Hormuz, but also potentially cyber attacks. Certainly, I think that is one of the weaknesses we have. So just get prepared, folks. It's not looking good. 2024 is an election year. The Fed's going to be printing a lot of money. There's going to be a lot of disruptions. You can expect more conflict, more financial crises. That is, I think, the menu for 2024. So get ready. Let me know what you think about any of these topics that we discussed in today's live stream, and I will catch you next time. Stay safe, everybody. Happy stacking. Smart Silver Stacker.